Welcome back to our intermediate financial accounting class. In this segment, we're continuing on with our discussion of adjusting entries. We've done several examples so far, and now we get to wrap them up. In the other segments so far during this lecture topic, we've talked about the accounting cycle, we've talked about why it matters, we've talked about identifying and recording basic transactions, posting, using the ledger equation to come up with the different pieces of the ledger balances, right? Either the beginning or ending balance, what we added, what we subtracted, etc. And then we talked about the trial balance, and now we're doing adjusting entries. We've talked about corrections and adjustments, and we have just a few last examples to wrap this topic or this part of the accounting cycle up. So let's go ahead and take a look at our next example right up here. We've gone back through our books and we found that on December 15th we recorded $12,000 as paid instead of payable. So the question is, do we have an adjusting entry? And the answer is no, we don't have an adjusting entry. What we have instead is a correction. This kind of thing happens all the time. We're going back to our books and we realize, whoops, I made a mistake. And now is a great time to fix it. Just so you know, you fix it now, because if you wait till later when you've done your closing entries, it's really a pain to go back and fix it. You can do it, it's just really hard. So it's better to find those mistakes and clean them up now, rather than letting the auditor catch them and then you get in trouble, or finding them later and having to do an adjustment through the statement of retained earnings, which is exciting but kind of a pain. So better to fix it now as we find them. So you do this all the time, going through adjusting entries. Now, the big difference, remember, between an adjusting entry and a correcting entry, other than the fact that you're just fixing a mistake with a correction, is that you can use cash. Because this is not an adjustment where cash is prohibited, right? Cash is never involved in an adjusting entry. But in a correction, I've done something wrong. To fix it, I might have to use cash. And that's the case here, because I showed it paid instead of payable. So I showed that I paid it, and I haven't. I just wanted to record that I owed it. So basically, I made a mistake in my entry. Let's go through the steps here to do a correcting entry. Step number one is to write down what you did. So let's see, on 12/15, I recorded payroll expenses of $12,000 as paid. Keyword here, paid, means that I recorded cash. Number two, I'm going to record what I should have done in making this journal entry. And what I should have done on 12/15, I still would have recorded that payroll expense of $12,000, but I should have put it into payroll payable or wages payable. Now you notice I haven't put descriptions on these because these aren't formally in the journal. This is just me making notes to myself. So I'm not going to bother with a description because it's not a real journal entry. So now step three is to go through these two and say, okay, what really needs to be fixed here? So as I'm looking at these, I'm going, well, let's see, these match up. They're right. I wanted $12,000. I should have $12,000 in payroll expense, and I do. So I don't need to fix this at all. It's good. The problem is I took it out of cash, and it should have gone into a payable. So I need to put this $12,000 back into cash and then record a payable because I owe it later. So that brings me to my last step. So on 12/31, I'm going to make a real correcting entry in the journal. I'm going to put the $12,000 back into cash because I didn't really pay it, and I'm going to record this payroll payable. So this is a correcting entry. For recording payroll as paid instead of payable. And that's how we do a correcting entry. Pretty cool, huh? Let's take a look at another entry now. Back to an adjustment, maybe. All right. Send out 5,000 coupons on November 15th. The coupons allowed customers to receive 5% off on any item during the next 30 days. Go ahead, take a second, and do the necessary journal entry. On December 31st, there would have been no entry. Why? Well, because from November 15th to 30 days later is 12/15, There's no journal entry there, no adjusting entry anyway. By 12/31, these things are expired, they've been used, they're all done. I wouldn't have to worry about them at all. You know, I put in several of these where there's no entry, and the reason for that is because it's that step one, do you need an entry, is such a crucial, crucial step. If you don't do that part right, you're going to mess up all sorts of things. So recognizing when you need one and when you don't is a crucial skill to doing adjusting entries. Let's take a look at the last of our examples. A customer payment on account was recorded as a debit to cash of $500 and a debit to accounts receivable of $50. So we need to make a correction. Did you do it? I hope you did, because this is kind of a unique example. In this case, I cannot do a journal entry for this. You look at it and you realize, okay, there's a mistake here, so I need to make a correcting entry and fix it. And here's where it all kind of goes south. The first step, of course, is what you did. And in this case, they debited cash for $500 and they debited accounts receivable for $50. There's no way to fix it. If the initial entry doesn't balance, you can't do a correcting entry to fix it. You can only do a correcting entry to fix it if it balanced originally. So in this case, you have no choice. You're going to have to go back and get rid of the initial entry and record it appropriately. Received payment on account. Okay? But you're going to have to go back and fix it. You can't use the shortcut, which is unfortunate. It's always fun to use the shortcut, but sometimes it doesn't work out. That's the last of our adjusting and correcting entry examples. I know, bummer that we're all done, but don't worry, there's more journal entries coming, so the fun will continue. At this point in the accounting cycle, we would get ready to do an adjusted trial balance. First thing we do is we would post all of our adjusting entries if we don't have a computer system that's posting them as we go. Then we would go through and find the new account balances. Some accounts are going to change, like wages payable probably has been tweaked a little bit, income taxes payable probably been tweaked a little bit, so the the account balance will be different than it was in the original trial balance. Some accounts will be getting an amount for the very first time. You may not have shown any income tax expense up to this point. Not a good idea, because the government doesn't like it when you don't pay over the course of the year. But maybe you haven't done anything with it yet. Could also be that you haven't done anything with your rent revenue yet, because I had it all in unearned revenue, and so there was nothing in rent revenue at all. Well, now there is. So you'll probably see a bunch of changes to the balances from the original trial balance, and you're going to see some brand new accounts. So again, you're going to get all of those ending balances. You'll create a new adjusted trial balance, and you'll make sure that your debits and your credits are equal so that you can avoid mistakes like this one that we just looked at, where you debited and debited instead of debiting and crediting. Once you're done with your adjusted trial balance, then we move on to preparing the financial statements, and that's where we're headed next. We'll see you then.